How to raise capital for your first acquisition as a nobody. Make sure you stick to the end because I'm going to go through 4 key principles that people forget and people don't even know about that could save years of your time chasing your own tail when you're working on raising money to acquire a business. So if you want to raise money to acquire a business, understand that you never have to use your own money. You can always use the money of other investors or the money of the company that you're looking to buy. How can you do that? There are 2 things. Number 1, there's something called, some people call it seller carry, some people call it vendor take back. But basically you can take the money, the existing profits of a company. Some people offer to use that money to pay for the acquisition. How is that possible? How is it that somebody can use the money of a business to pay for its own acquisition? It's really simple. When you acquire a company, you have to buy the entire value of the company. And if you get a loan to buy the company, you also have to pay the interest on the loan that you used to buy the company with. So one thing that people do is they get a loan to buy the company, but sometimes 99% of the time, the loan never covers 100% of the purchase price of the company. So what people do, because it doesn't cover the purchase price of the company, they may use some of the profits of the company to pay back to pay for the loan, number 1, and to pay for the down payments needed to acquire the business. So, because as I said, you may get a lender that lends you 75% of the value of the business, and maybe there's 25% left over, plus, let's say, an additional amount in interest payments that you have to pay back a lender. You could find a company that is making a lot of profit, and the owner can actually choose to use some of that profit to pay for the down payments and to pay for the interest payments on the loan that you get. So that's probably the lowest hanging fruit, and that's number 1. Number 2, you have to make sure, try to acquire businesses that have assets. So when I say assets, usually real estate is the best asset because real estate is usually the asset that you can get the most amount of lenders for. Because every Joe Blow, anyone on the streets usually can find a mortgage unless you have a horrible credit score. So it just shows that the thing that is lent the most to is usually real estate. So if the business has real estate attached to it, or it's even a real estate asset itself, then just try to get a loan to buy real estate or a business that's attached to real estate. If you try to get a loan to buy a business that is just cash flow heavy, that just generates cash, it can do okay, but the problem is you won't really find as many lenders, or if you do find lenders, the lenders usually won't be able to cover even half of the amount of the business. So that's number 2, make sure that the business has heavy assets and not equipment. Equipment's okay, not just cash, but has real estate assets. Number 3, if you need more money, make sure you find investors. So find people that you partner with to help you pay for the down payments, because usually you don't want to take all the money from the company to invest in a down payment, because the downside of using the seller, it's called seller carry or vendor take back, depending on where you are. The problem with this is that sometimes you take the profit out of the business to invest in you buying a business, but then the business has a lower profit margin afterwards, and the business would be exposed to more risk, especially if you are a new owner who's new to the business, and you may be in trouble if you can't grow the business as much as you thought you initially would. So one thing, some people partner with investors and then they raise money for the down payments. So these are equity, these are usually called equity investors, and they fund the down payments of the deal. So this is the 3rd way to raise money as a nobody. And the only concern is if you don't have trust from those investors, nor do you have trust from the business, if you're a nobody, I guess the main thing, and the last points I'll make is you can do a few things. Partner with people who you trust by having people have non-executive director positions in your company. Make sure that you tell people, hey, sit on my board, give me some guidance on acquiring a business, and in exchange for this, what I'll do is I'll put you on the pitch deck and I'll give you some percents of the deal when it closes, or I'll give you rights of first refusal. That just means that I'll give you the first opportunity to join in and invest in the business at a discounted rate, right? So you can give an advisor this idea, and you can say, hey, listen, advise my company. I put you on my pitch deck, and then because of that, people will trust me that I work with people that are smart. That's way number one. And another way is you can simply work with a company to get you proof of funds so that you can go to a seller and the seller can trust that you actually have the money that you say you have. Because if you're quote unquote a nobody, then nobody will believe you have money. So what we do is at Raises.com is we help people get a lot of letters of commitment, a lot of proof of funding, and we have our own letterhead. You know, we're working closely with a lot of regulators, and so people trust us. And so that shows the seller that we're serious about raising money for somebody. So that's pretty much it. And make sure that number one, use the money of the business to acquire a business. Make sure the business has a lot of assets that you can get lenders to lend to, and make sure that you work with investors. But in doing all those three things, you always want to make sure that you have credibility by bringing people on your board of advisors who you don't pay any money or any cents out of pocket for, by getting them to sit on quarterly meetings, to put them on their pitch deck, and brag that you work with people that are smarter than you so that you can build the credibility. And worst case, if somebody doesn't trust you, that you can acquire the business, just make sure you work with somebody that can get you a proof of fund letter or works with a lot of investment banks and a lot of investors so that the sellers of the business can trust that you can actually acquire them. So with this, I trust that this makes a little bit of sense. If you want to learn more, make sure you click around and head to Raises.com to learn more.